Welcome to This Explainer. I'm your host, and today we're systematically unpacking a highly critical accounting standard, IND AS 21, the effects of changes in foreign exchange rates. We'll be keeping a stable, measured pace as we go through this, making absolutely sure we thoroughly cover every essential requirement from the source material. So, if you deal with consolidated financials or cross-border transactions, well, you are exactly where you need to be. Now, you might be wondering, how do global companies balance their books across dozens of fluctuating currencies without descending into absolute chaos? It's a fascinating problem, really. Imagine booking a stellar profit on Monday, only to find it technically looks like a loss by Friday just because the currency markets shifted. No way, right? Well, let's dive into this. IND AS 21 is our definitive framework that prevents this exact headache. It prescribes exactly which exchange rates to use and how to report those tricky effects. Okay. Here's our roadmap for today's explainer. We're going to systematically cover the entire life cycle of a foreign transaction. We'll look at core currencies, determining functional currency, reporting transactions, presentation currency, and finally, disposals and disclosures. Let's jump right into Section 1, Core Currencies.
Right, so according to paragraph 8 of the standard, the functional currency is the currency of the primary economic environment in which the entity operates. Simply put, this is the main currency where the company actually generates and spends its cash. Think of a domestic IT firm right here in Bangalore, where all the local expenses are in rupees. That rupee is their underlying operational reality.
But what if the stakeholders are overseas? This brings us to a second vital definition. The presentation currency. This is simply the currency in which the financial statements are eventually presented to the world. For instance, a subsidiary might operate daily and keep its books in Indian rupees, its functional currency, but the parent company might demand the final consolidated reports in US dollars. Moving right along to Section 2, determining a functional currency. So how do we actually pinpoint this? Paragraphs 9 and 10 break this down into primary and secondary indicators. The primary indicators look at the main forces driving your business. Basically, what currency mainly influences your sales prices, what country's regulations dictate those prices, and what currency determines your labor and material costs. Then, secondary indicators look at where your financing actually comes from and the currency in which your operating receipts are retained. The absolutely crucial point here, straight from paragraph 12, is that when management has to use its judgment, those primary indicators take strict priority over the secondary ones. Now, the standard gets truly interesting when we look at foreign subsidiaries or branches. Paragraph 11 guides us through assessing if a foreign operation shares the parent company's functional currency or if it needs its very own. We have to ask some hard questions. Is the operation merely an extension of the parent, or does it have significant autonomy? Do its cash flows directly impact the parent? Can it service its own debt? Basically, if it operates independently, it dictates its own distinct functional currency. All right, let's get into the mechanics in Section 3, reporting transactions. Listen, before we record a single number, we absolutely must master the difference between monetary and non-monetary items from paragraph 16. It's a real game changer. Monetary items represent a clear right to receive or an obligation to pay a fixed number of currency units. Think cash, receivables, or lease liabilities. Non-monetary items, on the other hand, completely lack this fixed right. We're talking about things like inventory, property, or goodwill. Please keep this distinction front and center because your entire period-end accounting depends on it. Okay, so paragraphs 21 and 22 tell us exactly what to do on day one. On initial recognition, a foreign currency transaction must be recorded in the functional currency by applying the exact spot exchange rate right at the date of the transaction. Now, for practical reasons, you can use a reliable average rate for, say, a week or a month, but only if exchange rates aren't fluctuating wildly. So, what happens when we reach the end of the reporting period? Paragraph 23 outlines 3 strict steps. First, you translate your monetary items using the closing spot rate. Second, for non-monetary items measured at historical cost, you freeze the rate. Just keep using the exchange rate from the original transaction date. And third, for non-monetary items measured at fair value, you translate them using the exchange rate exactly on the date that the fair value was determined. Because exchange rates constantly fluctuate, differences will naturally arise. It's unavoidable. Paragraphs 28 to 30 instruct us on where this fluctuating value actually lands on the books. For monetary items, exchange differences are recognized immediately in the profit or loss statement, in the very period they arise. But for non-monetary items, the exchange difference just follows the item itself. If a gain or loss on a non-monetary item is recognized in other comprehensive income, well, the exchange component goes there too. If it goes to profit or loss, the exchange component follows suit.
Now, there is an important exception regarding monetary items that form part of a reporting entity's net investment in a foreign operation. Think of a long-term loan where settlement is neither planned nor likely anytime soon. Paragraphs 15 and 32 state that in the consolidated financial statements, these exchange differences are parked initially in other comprehensive income. They essentially accumulate in a separate component of equity until you actually dispose of that net investment.
Moving to Section 4, Presentation Currency. When we need to translate everything to a presentation currency, paragraph 39 mandates a highly specific mapping to ensure clean, consolidated reports. For each balance sheet presented, all assets and liabilities are translated at the closing rate. For the statement of profit and loss, income and expenses are translated at the exchange rates at the actual dates of the transactions. Now, because we're using different rates for the balance sheet and the income statement, an imbalance naturally occurs. It's like a giant puzzle with pieces that slightly shift size. All resulting exchange differences from this are neatly captured and recognized in other comprehensive income.
We must also highlight the special rule from paragraphs 42 and 43 for entities operating in hyperinflationary economies. Before you even think about applying the translation methods we just discussed, the entity must first restate its financial statements in accordance with IND AS 29, Financial Reporting in Hyperinflationary Economies. Only after that restatement is done do you translate all amounts into the presentation currency using the most recent closing rate.
And finally, Section 5, Disposals and Disclosures. Paragraph 48 states that when you finally sell or dispose of a foreign operation, it's time to deal with those exchange differences we parked earlier in equity. Upon disposal, that cumulative amount is reclassified from equity directly into profit or loss. This matches up exactly with when the gain or loss on the actual sale is recognized. To keep your auditors happy, paragraphs 52 through 54 lay out strict disclosure mandates. You absolutely must explicitly disclose exchange differences in profit or loss, as well as net differences in other comprehensive income. Also, if your presentation currency differs from your functional currency, you have to state that fact and explain why. Had a change in functional currency, you must disclose the change, the exact date, and the reason behind it. Finally, we need to look at Appendix B, which clarifies foreign currency transactions and advance consideration. When an entity receives or pays consideration in advance, it initially recognizes a non-monetary asset or liability. The crucial rule here is that the date of the transaction, for the purpose of determining the exchange rate when eventually recognizing the related revenue or expense, is the exact date the entity initially recognized that non-monetary asset or liability from the advance payment. This rule beautifully locks in the exchange rate. By dictating precise rules for functional currency, transaction reporting, and final presentation, IND AS 21 brings strict standardization to the complex, fluctuating world of global currencies. But I want to leave you with a question to ask yourself. Is your current accounting software truly capturing these nuances, or are you secretly leaking value through misapplied spot rates? I hope this structured breakdown has brought you some clarity today. Please like, share, subscribe, and follow for more explainers like this.